Imagine it is March 14th, 2001. You are a 52-year-old high school teacher living in Buenos Aires, Argentina. You have worked for the public school system for 28 years. You wake up at 6 every morning, take the bus to Escuela Normal Superior, and teach history to teenagers who would rather be anywhere else. Your life is not glamorous, but it is stable. You own your apartment, a modest 2-bedroom in the Flores neighborhood that your parents helped you buy in the early 80s. You have roughly $40,000. Saved in a peso-denominated bank account at Banco de Galicia. $40,000. That is 28 years of discipline. 28 years of packing lunch instead of eating out. 28 years of skipping vacations, driving a used Fiat, and telling yourself that patience and responsibility would be rewarded. Your savings sit in that bank account the way water sits in a glass. Safe, visible, going nowhere. And every single night, you sleep soundly because you believe the system that holds your money is as solid as the concrete walls of your apartment. If you have ever wondered why some people lose everything during a crisis while others walk through the same storm and come out wealthier than before, stay with me. What you're about to hear is not a theory, it is a pattern. It is repeated across 5 continents and over a dozen countries, across more than a century of modern economic history. And it always ends the same way. The people who only owned one category of asset got crushed. The people who understood all 4 categories did not just survive, they thrived. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Now back to Buenos Aires. In December of 2001, 9 months after that ordinary morning, the Argentine government froze every bank account in the country. They called it the Corralito, which translates roughly to little fence. That little fence locked $40 billion of ordinary people's savings behind bank doors that would not open. Your $40,000 did not disappear in a fire. It did not get stolen by a thief in the night. It was simply declared unreachable by the same government and the same banking system you trusted your entire adult life. When the peso was eventually devalued and depegged from the US dollar in early 2002, the purchasing power of those frozen savings collapsed by roughly 70%. 28 years of sacrifice became worth the equivalent of about $12,000, not because you did anything wrong, but because every single dollar you ever saved was sitting in the worst category of asset a person can own during a systemic crisis. And you did not even know there were categories. This video is about the 4 categories of assets, not specific investments, not stock tips, categories. Think of them as 4 fundamentally different containers for storing and growing your wealth. Most people on Earth, most hardworking, responsible, well-intentioned people, keep almost everything they have in only one of those containers. And history shows, again and again, that it is the one container most likely to crack when the ground starts shaking. Before we go further, there is something important to understand. This is not about rich versus poor. This is about structure. The structure of what you own matters more than how much you own. A person with $50,000 spread across all 4 categories has historically been more resilient than a person with $500,000 concentrated in just one. That is counterintuitive. It feels wrong. But the historical record does not care about how things feel. It only cares about what actually happened. So let me give you the framework. Think of the economy like a building with 4 floors. Each floor represents a different category of asset. The ground floor is cash and cash equivalents. This includes physical currency, checking accounts, savings accounts, money market funds, and government bonds with short maturities. This is what most people think of when they hear the word savings. It is the most familiar floor. It is where the lights are brightest. And it is the floor that floods first. The second floor is real assets. These are physical things you can touch. Real estate, farmland, commodities like gold and silver and oil, and infrastructure. Things that exist in the physical world independent of any government's promises. The third floor is equity ownership. This means owning a piece of a business. Stocks, shares in private companies, or your own business. When you own equity, you do not just store value. You own a claim on future profits, on the productive capacity of human effort and innovation. The fourth floor is what we might call alternative or non-correlated assets. These are things that do not move in lockstep with traditional markets. Historically, this included art, rare collectibles, foreign currency holdings, and in the modern era, digital assets like cryptocurrency. These are the assets that often behave differently when everything else is falling apart. Now, here's the key. Each floor has strengths, each floor has weaknesses. No single floor is safe in every scenario. But the ground floor, cash and its equivalents, has one specific and devastating vulnerability. It is the floor most directly controlled by governments, central banks, and banking systems. It is the floor where the rules can change overnight. And it is the floor where most people, in most countries, keep most of what they have. Understanding why that matters requires looking at what has actually happened when that floor flooded. And it has flooded many, many times. This brings us directly to the first category in the first case study. Cash and cash equivalents are what economists call nominal assets. Nominal means in name only. A $100 bill says $100 on it. That is its nominal value. But what that $100 can actually buy, its real value or purchasing power, is a completely different thing. And the gap between those two numbers is where ordinary people get quietly destroyed. Consider what happened in Germany between 1921 and 1923. The Weimar Republic had financed World War I largely through borrowing rather than taxation. After the war, crippled by reparations, payments demanded by the Treaty of Versailles, and struggling with a shattered industrial base, the government began printing money at an accelerating rate. In January 1921, $1 was worth roughly 60 German marks. By November 1923, $1 was worth 4.2 trillion marks. That is not a typo. Trillion. A loaf of bread that cost around half a mark in 1921 cost 200 billion marks by late 1923. Hyperinflation, which means prices rising so fast that money becomes worthless faster than you can spend it, did not hurt everyone equally. It was a targeted destruction of a specific class of people. The people who held cash, the people who had savings accounts, the people who owned government bonds, pensioners, teachers, civil servants, widows living on fixed incomes from their deceased husbands' government pensions. These people were not gamblers. They were the most responsible citizens in the country. They had done everything right, and they were wiped out. Meanwhile, who survived? Industrialists who owned factories, farmers who owned land and livestock, people who held their wealth in real assets on the second floor or in equity on the third floor. Hugo Stinnes, a German industrialist, actually became one of the richest men in Europe during the hyperinflation. He had borrowed heavily in marks to buy real assets like coal mines, shipping lines, and newspapers. As the mark collapsed, his debts evaporated in real terms while his physical assets held their value. The cash holders lost everything. The asset holders gained everything. Same country, same crisis. This leads to the second part of this story. If you had to guess right now what percentage of your own net worth sits on that ground floor, drop your answer in the comments. Seriously, be honest with yourself, because what I am about to show you next is the part of this story that most people never hear, and it changes everything. The second category is real assets: land, property, commodities, physical things. History tells us these assets are not just stores of value. They are anchors. When the paper system loses its grip, real assets are what people grab onto, but they come with their own risks that most people overlook. Consider Zimbabwe between 2007 and 2009. By November 2008, inflation reached 79.6 billion% per month. Prices were doubling every 24 hours. The government printed a $100 trillion note. Cash was destroyed. Bank accounts were meaningless. But farmers with productive land found their land still grew crops. Their cattle still had calves. A hectare of fertile soil was still a hectare of fertile soil. Gold became a parallel currency. But real assets can be seized. Zimbabwe's land reform program forcibly redistributed farmland to political allies. In Cyprus in 2013, the government imposed a forced tax on bank deposits. Deposits above 100,000 euros faced a 47% haircut. Now for the third category, equity or ownership of businesses. In 2008, the S&P 500 fell 57%, yet by 2013 it recovered, and by 2021 it quadrupled. A person in cash saw their purchasing power erode, but the equity story requires diversification. Look at Japan in 1989. It took 34 years for the Nikkei to surpass its 1989 high. Concentration in one country carries enormous risk. Diversification, which means spreading your ownership across many businesses in many countries, is what turns the third floor from a gamble into a fortress. See 2026 Script Scene Splitter AI GitHub. At this point, the pattern becomes impossible to ignore. Most people will never know what you now know. Most people will keep their entire life savings on the ground floor of a building that has flooded repeatedly throughout history. They will keep trusting systems that have frozen accounts in Argentina, confiscated deposits in Cyprus, and printed currencies into oblivion in Germany, Zimbabwe, and Venezuela. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three categories together. Cash failed in Weimar Germany. It failed in Zimbabwe. It failed in Argentina. It failed in Venezuela, where the believer lost more than 99.99% of its value between 2012 and 2020. It failed slowly and quietly in every country that has experienced even moderate inflation over long periods, including the United States and the United Kingdom, where the dollar and the pound have both lost more than 90% of their purchasing power over the past century. Real assets held up better, But they were seized in Zimbabwe, taxed in Cyprus, and frozen by capital controls in Greece in 2015, where the government limited ATM withdrawals to 60 euros per day and imposed restrictions on property transactions. Equity performed well over long periods in many countries, but devastated those who were concentrated in single markets at the wrong time, as Japan showed for 34 years. Each floor of the building has a crack. Each floor has a scenario where it fails. And this is precisely why the fourth floor exists. The fourth category, alternative or non-correlated assets, includes things like gold held outside the banking system, art, rare collectibles, foreign currency reserves held in stable jurisdictions, and more recently, digital assets like Bitcoin. The defining feature of this category is that these assets do not depend on any single government, any single central bank, or any single banking system to maintain their value. Gold is the oldest example. For more than 5,000 years, gold has served as a store of value precisely because no government issues it. No central bank can print more of it, and it is universally recognized across borders and cultures. During the Lebanese financial crisis that began in 2019, when banks froze deposits and the Lebanese pound lost more than 90% of its value against the dollar, families who held physical gold or had assets denominated in foreign currencies outside the Lebanese banking system were able to preserve their purchasing power. Those who had everything in Lebanese pound-denominated bank accounts watched helplessly as their life savings evaporated behind locked bank doors. The same pattern appeared in Venezuela. As the bolívar collapsed, those with access to US dollars, gold, or even Bitcoin were able to buy food, medicine, and essentials. Local Bitcoins, a peer-to-peer Bitcoin trading platform, saw its Venezuelan trading volume surge to record levels between 2017 and 2019 as ordinary people used cryptocurrency as an escape hatch from a collapsing monetary system. This is not an endorsement of any specific asset. It is an observation about a pattern. When the ground floor floods, and sometimes when the second and third floors crack too, the fourth floor is often the last one standing. Not because it is perfect. It is not. Gold pays no dividends. Art is a liquid, meaning it is hard to sell quickly. Cryptocurrency is volatile, meaning its price swings wildly in short periods. But in the specific scenario where trust in institutions collapses, the fourth floor provides something the other three cannot: independence from the very systems that are failing. And this is where history gets uncomfortable, because the people who get hurt the most are never the people you would expect. They are not the reckless. They are not the gamblers. They are not the irresponsible. They are the careful ones, the responsible ones, the ones who did everything society told them to do. In every single crisis we have discussed, the people who suffered the most shared a common profile. They were middle-class savers. They were pensioners and retirees living on fixed incomes. They were small business owners who kept their operating cash in a single local bank. They were government employees whose salaries, pensions, and savings were all denominated in the same local currency, held in the same local banking system. In Argentina in 2001, it was teachers, doctors, and shop owners who lost their savings in the Corralito. In Cyprus in 2013, it was retirees and small business owners who had their deposits above 100,000 euros partially confiscated. In Greece in 2015, pensioners lined up outside banks to withdraw their maximum 60 euros per day, some of them collapsing in the summer heat. In Lebanon, starting in 2019, middle-class families who had saved for decades in Lebanese banks found themselves unable to access their own money. Hundreds of thousands of families saw their net worth effectively erased. Some estimates suggest that Lebanese depositors lost access to over $100 billion in frozen accounts. Now contrast this with who walked through these same crises largely unharmed. In almost every case, the survivors fell into three broad groups. First, people who owned real assets, particularly real estate and productive land, that generated income independent of the banking system. Second, people who owned equity in diversified international businesses, whose earnings were not tied to a single collapsing economy. Third, people who held a portion of their wealth in alternative stores of value outside the direct control of their local government and banking system. This was not about being rich. Plenty of wealthy people who kept all their wealth in local bank deposits got destroyed too. In Lebanon, millionaires on paper became effectively broke overnight. It was about structure. It was about which floors of the building held their wealth. The question is not whether this pattern will repeat. History has already answered that. From Weimar Germany to modern-day Lebanon, this pattern has repeated in some form in at least a dozen major economies over the past century. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what did the survivors actually do? The historical record shows that those who came through these periods largely shared three characteristics. The first characteristic was distribution across categories. They did not keep everything on one floor. They had some cash for daily needs, yes, but they also owned real assets. They also owned equity in productive businesses, often international ones. And they held at least a small portion of their wealth in assets that did not depend on any single institution. The second characteristic was geographic diversification. This means they did not keep all of their assets in one country. The Argentine savers who had opened bank accounts in Uruguay or held US dollar-denominated assets outside of Argentina before the Corralito were largely protected. The Lebanese families who had transferred some savings to banks in Europe or held foreign real estate did not lose everything when the Lebanese banking system froze. This is not about disloyalty to one's country. It is about recognizing that no single system, no matter how stable it appears today, has been immune to crisis throughout history. The third characteristic was skepticism of consensus. In every single case we examined, the majority believed the system was safe right up until the moment it was not. In Argentina, in 2001, most people trusted the peso-dollar peg. In Cyprus in 2013, most depositors believed the European Union would never allow a deposit confiscation. In Lebanon in 2019, most people trusted their banks because the banks had been stable for decades. The survivors were not people who predicted the future. They were people who studied the past. They recognized that stability is not the same as safety. A building can stand perfectly still for 50 years and still have cracks in its foundation that will bring it down on the 51st. The survivors looked for cracks while everyone else admired the building. Now let me bring you back to Buenos Aires. Let me bring you back to that 52-year-old teacher in Flores. After the Corralito, after the devaluation, after losing roughly 70% of his life savings, in real terms, he kept teaching. He had no choice. He was 53 years old, with a pension that had been decimated and savings that could no longer fund the retirement he had planned. He taught for another 12 years, retiring at 65 with far less than he had expected. His apartment in Flores, the one his parents helped him buy, kept its value reasonably well. It was, in the end, the only thing that saved him from complete financial ruin. But everything he had worked for in that bank account, everything on the ground floor was largely gone. And here's the part that stays with me. He was not irresponsible. He was not ignorant. He was a history teacher. He taught his students about economic crises in other countries. He just never believed it would happen. In his country, to his bank, to his account, that is the most human thing in the world. And it is the most dangerous. Because the pattern does not care about belief. It does not care about nationality. It does not care about good intentions. The pattern only cares about structure. What do you own? Where is it held? And is it all on the same floor? The 4 categories of assets are not a magic formula. No single allocation protects against every possible scenario. Cash is essential for daily liquidity and short-term needs. Real assets provide tangible value and inflation protection, but can be seized or frozen. Equity in diversified businesses provides growth and adaptability, but carries market risk and requires patience. Alternative assets provide independence from institutional systems, but carry volatility. No floor is perfect. But history shows, with painful clarity, that standing on only one floor, especially the ground floor, is the single most reliable way to be in the wrong place. When the building shakes. And buildings shake. They always have. They always will. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will watch it and change nothing. But if one person in your life is keeping everything they have on the ground floor, if one person in your life is sleeping soundly because they trust a system they have never questioned, share this with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one. See 2026 Script Scene Splitter AI GitHub.